Hello and welcome. Today we're diving into a real financial head-scratcher from Tianjin pharmaceutical Tang Group. Their latest results seem to completely defy logic. Revenue is way down, but profits have just exploded. Now, this isn't just a story about numbers on a spreadsheet. It's about a massive strategic shift that could really reshape the whole company. So let's get into it and piece this puzzle together. Okay, so let's just start with the big question right off the bat. How on earth does this happen? I mean, on the surface, these numbers make absolutely no sense. A 35% drop in revenue, normally that's a 5-alarm fire, a sign that something is seriously wrong. But at the same time, their net profit shot up by 168%. It's not a typo. And this is the paradox we're going to unravel today, because the answer tells us a whole lot about a really deliberate and dramatic change happening inside this company. And this chart just lays it all out visually, doesn't it? On one side, you see that revenue bar taking a nosedive. But then look to the right. The net profit bar is just rocketing in the complete opposite direction. This isn't just data. It's the whole story in one picture, showing two of the most important metrics for a company going in completely different directions. So let's start digging into these numbers and figure out what's really going on. How did they pull off such a strange-looking result? We're going to go past the shocking headlines and get right into the mechanics of their financial reports to see what's happening behind the curtain.
You know, the first thing to understand is that what we're seeing here isn't a sign that the business is failing. That revenue drop isn't because customers suddenly stopped buying their products. Nope. This is the calculated result of a major strategic decision. The company's been actively reshaping what it does, and these numbers are just the aftershocks. It's a classic case of addition by subtraction. All right, let's tackle the first mystery. Where did all that revenue go? A 35% drop is a big deal. We're talking about almost 2 billion RMB that was there last year and has just vanished this year. So what happened? Did they have a product recall? Did a major market collapse? Well, the answer is actually a lot more about accounting than you'd think, and it has a huge impact on how a company's performance looks on paper.
And here it is, the main culprit, right from their own financial filings. The drop was, and I'm quoting here, mainly due to a change in the company's consolidation scope. So what does that mean? Well, the report goes on to say that the numbers from a company called Tianjin Zhongxin Medicine were taken out of this period's results. So Tang didn't lose this revenue in the usual sense. They basically just removed an entire business from their financial reports.
Yeah, this whole process has a name. It's called deconsolidation. The easiest way to think about it is like this. Imagine you own a fancy, high-end restaurant, but you also own a high-volume, low-profit hot dog stand on the side. For years, you report the combined sales of both, but then one day you decide to sell the hot dog stand. Well, your total revenue is going to drop, maybe by a lot, but your overall business might actually become more profitable and way easier to manage. And that's pretty much what happened here.
And here is the why. This is the payoff. By getting rid of that lower margin business, the company's overall profitability just soared. The gross profit margin, which is basically how much profit they make from each sale, jumped from 48% all the way up to a really impressive 73%. So while the top-line revenue number went down, the quality and profitability of every dollar they did earn went way, way up. This wasn't a retreat, it was all about focusing on what really works. Okay, so we've cracked the revenue mystery. It was a deliberate choice to boost profitability. But that still doesn't explain the other side of this weird equation, that incredible 168% explosion in net profit. I mean, a better profit margin is great, but it's not going to get you that kind of growth all by itself. So this second half of the puzzle is all about where this giant pile of cash actually came from. And the key here is realizing that this huge profit didn't come from their day-to-day business of making and selling medicine. This isn't a recurring thing. Instead, it was a one-time windfall from selling off some assets. The financial statements are super clear on this, saying the increase was mainly attributable to the gains they made from 2 specific sales of business interests. And here is the big one, the lion's share of that profit. The company reported a net gain after paying taxes of about 1.31 billion RMB. This single transaction came from selling off the rest of their stake in an associated company. Now, to put that into perspective for you, this one sale alone brought in more money than the company's entire net profit from the year before. So yeah, this massive profit figure is really all about cashing out on a big investment. The report actually gives us the exact breakdown under a line item called Other Gains. And you can see it right here.
The pre-tax gain from selling that Sino-American Tianjin stake was a massive 1.54 billion RMB. There was also a much smaller gain, about 17.4 million, from liquidating another subsidiary. So when you add these up, you see exactly where that profit explosion came from. It's not recurring income, it's the result of some major corporate house cleaning. So now we've basically solved the puzzle. The revenue drop and the profit boom are really just two sides of the exact same coin, a big strategic restructuring. But that leads to an even bigger question: why now? And to answer that, we need to zoom out from the financials and look at the bigger picture of what's happening in the traditional Chinese medicine industry. This is where all these moves start to make a lot more sense.
The company's own report gives us a really great snapshot of the industry right now. First off, there's strong government support, which is a huge plus. Second, and this is so important, the whole industry is shifting away from just getting bigger to a new focus on quality and value first. At the same time, there's a big push for digital tech and innovation. But there's also a major challenge. The cost of raw materials is surging, which is putting a ton of pressure on profits. This environment perfectly explains our strategy. If quality is key and costs are rising, you have to double down on your high-margin, high-value products.
And this is exactly how Tang is responding. They're lining up their strategy perfectly with those industry trends. They're deepening their brand strategy, spending more on R&D, it's up 6%, they're innovating their marketing, and are upgrading their management to be more efficient. Selling off lower-margin businesses and non-core investments, that fits perfectly with this plan to build a leaner, stronger, and much more focused company.
You know, this quote from their own report just sums it all up perfectly. This isn't just about moving money around. It's about changing the company's identity. They're working towards a vision of becoming a market-driven, tech-enabled leader. Every single decision we've looked at today, selling a subsidiary, cashing out an investment, reinvesting in their core brand, it's all a step toward making this vision a reality.
And so that brings us to the final question. The company has pulled off a really dramatic financial maneuver. They've cleaned up their business and sharpened their focus. That one-time profit has given them a huge pile of cash. But what happens next? Has this whole transformation truly set up Tang for healthier, more sustainable growth down the road? Or was this just a short-term financial trick? The puzzle of Q3 is solved, but the question of the company's long-term health, well, that's still an open one.